I don't own paper. I have nothing that's a derivative. I know I have 90% in hard assets, gold, silver, real estate. I don't save cash. I save gold and silver. And if I ever need the cash, I think gold and silver are liquid.
Gold and silver are the only assets on the planet that are not simultaneously someone else's liability. So in a world where counterparty risk could become accentuated or come into play, the removal of counterparty risk by taking possession of this metal is very illuminating.
In times of black swan, whether it's the dollar going up or crashing down, or time, who knows, World War III, we could be on the brink of that. What you want to own is you want to own an asset that has no counterparty risk.
The U.S. economy is grappling with persistent inflation and a declining personal savings rate, sparking criticism from financial experts and prompting discussions on effective hedging strategies. The precious metal is considered a safe haven against inflation and has risen 10% since the start of the year. Robert Kiyosaki, the founder of Rich Dad Poor Dad, has touted gold for years, referring to gold and silver as real money instead of fiat currency, which he calls trash. Even many other famous analysts, such as Jim Rickards, Andy Schectman, Rick Rule, and many others, see gold as an inflation hedge. This is because when prices rise, cash loses its purchasing power. In contrast, precious metals like gold tend to see price rises and, therefore, have the potential to preserve their value in an inflationary environment. Historically, gold has performed well during inflationary periods. For example, the 1970s kicked off with an average inflation rate of 5.84%, and soared to 13.58% by 1980. According to Nasdaq data, gold prices soared from $35 to $850 per ounce during the same decade. Regarding bull and bear markets in gold, the famous analyst Jim Rickards, former national security advisor at the Pentagon and the CIA, explains that historically, until 1971, gold served as money, so there weren't distinct bull or bear markets. Since Nixon suspended dollar redemption for gold by foreign partners in 1971, gold has operated independently. The first bull market was from 1971 to 1980, followed by a prolonged bear market until 1999, then another bull market until 2011. The third bull market began in December 2015, when gold hit $1,050 per ounce, signifying a potential market bottom. Jim believes this third bull market in gold, which started in December 2015, indicates a historical shift, as gold has detached from its previous ties to the dollar since 1971, leading to distinct bull and bear markets for the precious metal. Now we will present you with clips of famous experts, including Robert Kiyosaki, highlighting the importance of gold as an inflation hedge. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
We're in the third great bull market in gold in history. When I say in history, you're like, well, gee, history is a long time. How come this is only the third bull market? Well, the answer is for almost all of history up until 1971, gold was money. So you didn't have bull markets or bear markets. It was just gold. That was the money. And you thought about it by weight. You say, well, I'll give you an ounce of gold for this property, or I'll give you, a quarter ounce for, some food or groceries or whatever. So you thought about gold by weight. It was money. Constant store value. So it's really only since 1971, when Nixon suspended redemption of dollars for gold by our foreign trading partners, that gold just went its own way, detached from the dollar. So the dollar would do what it was going to do, and gold had its own market and still does. The first great bull market was 1971 to 1980, and gold went up over 2,000%, from $35 an ounce to $800 an ounce in January 1980. Then there was like a long, drawn-out, almost 20-year bear market from 1980 to 1999, and gold dropped down to around 250. So it went from the 800 level down to 250. The second great bull market was from 1999 to 2011. August 2011, gold went from $250 an ounce to $1,900 an ounce. That was an almost 700% gain. Then the second bear market, August 2011 to December 2015. The third bull market, I can give you the exact date, December 16th, 2015. Gold hit $1,050 an ounce. That was the bottom of the second bear market I described, a pretty steep fall from the 1900 level. But you could tell it was the bottom. You say, well, how do you know that? If the first bull market was up 2,000% and the second bull market was up 700%, if you just take the average of those two, you don't have to pick the higher of the two. You don't have to go crazy or say it'll be bigger than ever. It could be, but you don't have to do that. If you just take the average of those two, you would come up with a number around 1,400% gain from from the 1050. Well, that would put you at almost $15,000 an ounce. So in other words, and the same time period, the first bull market was 8 years, 9 years. The second bull market was 12 years. Just take the average, you get 10 and a half years. So from December 2015, just using the averages, not anything crazy, 10 and a half years up, 1,500%, bingo, it puts you at $15,000 an ounce in 2025. And by the way, don't wait. If you agree with that analysis and there's more to back it up, don't wait until 2025. People say, oh, okay, well, it's going to be $15,000 an ounce. I'll go out and get it in 2024, I'll catch the wave. No, it's a long way between here and 1,500. I mean, you got to get to 3,000, 4,000, 5,000, 6,000, 7,000, et cetera. You got a long way to go to 15,000. So why not get the gold now, which I do recommend, and then enjoy all those profits. Don't wait to the end, because it could happen. There could be like a little spike at the end.
Gold, renowned for its high liquidity, offers easy buying and selling options through various avenues like ETFs, IRAs, and futures. What distinguishes gold in the investment landscape is the transparency inherent in its spot prices, which play a pivotal role in alleviating equitable market pricing concerns. This transparency ensures that individuals engaging in transactions involving gold are equipped with transparent and easily interpretable pricing data, fostering confidence and trust in the reliability of these transactions. Analyst Rick Rule, CEO at Rule Investment Media, underscores the extreme liquidity of gold and silver, positioning them among the most liquid asset classes globally. He prefers lending against these precious metals, particularly when controlling the collateral rather than the borrower. Additionally, the CEO of Miles Franklin, Andy Schectman, highlights the unexpectedly significant current landscape. He points to various factors contributing to this, such as the global scale of events involving 200 countries, initiatives like the Belt and Road Initiative, the reclassification of gold to Tier 1, central banks repatriating gold reserves, and the IMF's pursuit of a new standard. These collective developments prompt Andy to contemplate their more significant implications, suggesting an ongoing notable shift or transformation. Let's get back to the interview.
No, gold and silver are extremely liquid. They're one of the most liquid asset classes in the world. I'm a lender, and I love lending against gold and silver, particularly gold and silver where I control rather than the borrower controlling the collateral. They're enormously liquid. I live in a circumstance that, even given the problems that we face today, is substantially more civilized, more benevolent than the young Vietnamese woman who, the choices that she had in terms of her savings and her business were limited compared to the choices that you and I exhibit. Also, because of the asset classes that I deploy capital into include what you would call derivatives, what I would call securities. Having access to cash to access securities markets without having to sell my gold or silver is convenient for me. Interestingly, because as an example, I'm the largest shareholder of Sprott, a large financial services concern which is built around gold or silver. A financial planner would tell me that I didn't need to own any gold, that my life was already leveraged to gold. But again, owning physical gold makes me sleep better.
This is bigger than even I had thought. When you have 200 countries from around the world on top of the Belt Road Initiative, on top of gold being reclassified Tier 1, on top of all the central banks repatriating their gold, now the IMF wants a new standard. So now I'm convinced something's going on. If I own 1,000 ounces of gold in my warehouse, I'll sell 1,000 ounces on paper on COMEX. So if the price in my warehouse drops by down $100,000 because what I sold short on COMEX goes up, commensurate, it allows me to offset my risk, to be market neutral. Or a farmer who plants a field of grain in April can sell the future production to the baker in October to make bread. He wants the wheat. The farmer doesn't have to go the whole growing season with the uncertainty of the weather and the crop and all that stuff. It's just a way to offset risk by people who deal in commodities. Well, it's turned into a casino for sure. But what happened in 2020 was this group, the others, started to drain the market, the COMEX market, of physical supply. when no one ever took possession, they took off in 1 year in 2020 more silver than we've seen in a typical decade being removed, and more gold that year than the Bank of Japan has in its official holdings. So now you have the most private, the most well-funded, well-informed private investors doing the exact same thing that the commercial banks and the central banks have been doing, and that is massively accumulating metal and taking possession.
It's a commodity like anything else. It's demand supply driven. So the price action we're enjoying right now in gold and have over the last couple of years and likely to enjoy going forward is being driven by two factors. One is this declining supply. So it's a remarkable inelasticity of supply to price. Even as the gold price has been going up, the industry can't just flick a switch and add more supply. The lead times in new production are long, sometimes decades, to bring new mines up into productive capacity. But the demand side of it is also very, very constructive because we're in a lower for longer interest rate environment. We're actually experiencing nominal rates that are negative in some cases. And on a real basis, for sure, given where inflation is, we have negative real interest rates on sovereign debt. So there's no opportunity cost to owning gold today. It is the one financial instrument, monetary instrument, that doesn't yield anything. But when sovereign debt is yielding negative on real basis, gold is not a great place to park your capital, and it's very finite in quantity. So it's really driving capital flows into gold, and for that matter, into cryptocurrencies, which is being perceived as a store of value like gold, as an alternative to gold, is the undermining of fiat currencies that's going on with printing, with reckless abandon by central banks on a coordinated basis globally, debasing their currencies to inflate the economies and debase also the debt. The massive amounts of sovereign debt that's been strapped on is unprecedented. And the only way that these governments can hope to repay the debt is basically to debase the debt. And the way to debase the debt is to debase the underlying currencies.
The gold market is expected to keep drawing investments, with central bank purchases supporting its pricing. Analysts predict gold to surpass $3,000 per ounce by 2025. Robert Kiyosaki forecasts it hitting $5,000 soon, and many banks agree that gold has substantial potential in the next 5 years. Are you considering buying gold as a hedge against economic uncertainties? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.